What happens when a technology conglomerate running at the absolute limits of global scale needs to maintain a specific growth narrative?
You track the way they count.
We are auditing Microsoft's Q4 fiscal year 2026 earnings call today. It is a mechanical review of the divergence between what management promised the market in April and what they actually delivered in July.
And for you listening, the analytical value of this deep dive does not reside in the headline numbers.
It resides in the gap. We are isolating the 90-day window where language shifted, accounting estimates were modified, and, well, measurement baselines were quietly reoriented.
The baseline for this audit is established by the delivered metrics, and those reflect undeniable historic scale. Management reported a record close for the fiscal year.
Annual revenue reached $331 billion.
The Azure cloud segment crossed the $100 billion threshold, and paid Copilot seats surpassed 30 million. These headline figures are real, verified, and supported by the filings.
But our function today is to look underneath those figures, to audit the underlying mechanics of how they were achieved and, frankly, presented.
So we begin with the delivered analytical label, focusing heavily on the Azure revenue acceleration.
In April, CFO Amy Hood guided for Azure constant currency growth of 39% to 40% for the fourth quarter.
Let us briefly define constant currency for the listener before we unpack the delivery.
Yeah.
It is a reporting metric that strips out the effect of fluctuating foreign exchange rates.
Because if the U.S. dollar strengthens significantly during a quarter, international revenue just looks smaller when it is converted back to dollars for reporting.
Exactly. So by utilizing constant currency, management provides a cleaner view of actual operational sales volume, independent of currency market volatility.
The July result posted at 33% constant currency growth. The execution exceeded the guided ceiling.
Hood cited two specific operational mechanisms for this beat: fleet efficiency gains that released monetizable capacity mid-quarter and accelerated rack installation times.
Management noted in April that overall demand exceeded supply and that efficiency improvements are quickly monetized. That narrative held verbatim into July.
However, the mechanical breakdown of that 43% result requires strict separation. Management indicated the beat was driven by structural infrastructure efficiency, combined with earlier-than-expected delivery of new capacity.
But they additionally cited a revenue acceleration stemming from a June pricing model change for GitHub Copilot.
This is where the distinction becomes analytically critical for anyone modeling future quarters. Fleet efficiency is a structural driver. It is a repeatable margin lever.
The GitHub pricing change, conversely, is a discrete pull forward of revenue into the current quarter.
Management did not cleanly separate the structural infrastructure efficiency from that discrete GitHub pricing pull forward on the call.
The blended 43% figure groups a structural, repeatable operational gain with a one-time monetization event. It is material discrepancy in evaluating the quality of the revenue beat.
If you are projecting growth based on a 43% run rate, you need to know how much of that was structural versus pulled forward. And the analyst pool failed to press for this separation during the Q&A session.
Moving down the balance sheet from revenue to capital expenditures, we observe a parallel dynamic. We see guidance met through structural reclassification rather than operational containment.
April guidance projected Q4 CapEx at over $40 billion. July reported $41 billion. The delivery is technically within range.
However, on the July call, Hood announced a significant change in accounting estimates. Beginning in fiscal year 2027, Microsoft is extending the estimated useful life of its data center assets from 15 years to 25 years.
The mechanical impact of extending an asset's useful life requires precise attention.
Hold on, mechanically, what does moving something from a 15-year life to a 25-year life actually do to the bottom line, specifically regarding lease classifications?
Extending the useful life changes the accounting criteria, which reclassifies a meaningful portion of finance leases into operating leases. Standard accounting principles treat these two structures differently.
Operating leases are removed from the CapEx line entirely
and recorded elsewhere on the cash flow statement. As a direct result of this single reclassification, the calendar year 2026 CapEx expectation dropped from approximately $190 billion down to approximately $175 billion.
But the underlying physical investment velocity, the rate at which they are pouring concrete and installing servers, that has not changed.
Right. The balance sheet classification has changed.
Let us contextualize this mechanism for the listener. It is structurally identical to taking out a 15-year commercial mortgage and 10 years in, calling the bank to restructure it into a 30-year mortgage.
The physical property costs the exact same amount. You still owe the total principal.
However, your near-term monthly obligation suddenly drops, giving the financial optic of having more cash on hand and lower current expenses.
The source material labels this a convenience pivot. The disclosure was proactive, the mechanism was technically explained, and it does not constitute a financial restatement.
The timing of the announcement, however, is the operative variable. Announcing an accounting estimate change on the exact same call that delivers forward CapEx guidance compresses the window for investor recalibration.
The headline CapEx number is mathematically smaller, which mechanically mitigates market concerns about runaway infrastructure spending. But the aggregate cash requirement for the underlying physical assets remains identical.
Having audited the infrastructure costs, we must evaluate the adoption metrics that justify those costs. This requires tracking how measurement windows and primary signals shift once a specific operational scale is achieved.
We apply this framework first to Copilot seat trajectories. In April, management reported over 20 million paid Copilot seats, projecting sequential increases.
July delivered 30 million seats. Net additions more than doubled quarter over quarter.
The 10 million seat delta reflects a verifiable inflection in raw adoption. However, the analytical focus must center on the framing shift.
In April, the primary signal delivered to the market was year-over-year seat growth. Seat counts were positioned as the definitive proof of product-market fit.
By July, the narrative pivoted away from unit volume and toward usage intensity.
Management highlighted that conversations per user nearly doubled year over year. Time to deployment collapsed from months down to days.
And weekly engagement reached parity with established enterprise platforms like Outlook and Teams. We must assess why that transition occurred.
When the denominator is smaller, absolute unit growth is the most aggressive primary metric. At 30 million seats, the sheer volume of units becomes standard context.
Engagement depth replaces unit growth as the forward-looking indicator for retention and pricing power.
The proof of traction shifted from a volume metric to a utilization metric. It was executed without a formal transition announcement.
We see a parallel baseline shift in infrastructure deployment metrics, specifically regarding dock-to-live times for new graphics processing units.
In April, management cited a nearly 20% reduction in dock-to-live times for new GPUs in their biggest region since the beginning of the year.
In July, the replacement metric provided was a nearly 50% reduction over the last fiscal year. Mechanically, the headline number increased from 20% to 50%.
Both statements are factually true based on the internal data provided. The divergence is entirely in the measurement anchor.
The April metric was current year-to-date. The July metric anchored to the full trailing fiscal year.
The full fiscal year includes the Q4 result, but it fundamentally alters the denominator of the equation.
By extending the look-back period, the headline efficiency metric was mathematically tripled, but the measurement window was changed to accommodate that larger figure.
We will now audit the metrics and specific product initiatives that were downgraded or omitted between the two calls. We categorize these as reprioritized and evaporated narratives.
We begin with the enterprise software segment, Dynamics 365. In April, Dynamics 365 reported 22% year-over-year revenue growth.
Management explained a noted weakness in forward bookings as a structural consumption transition. They stated that enterprise customers were actively balancing their spend between traditional per-seat licensing models and emerging consumption-based models.
The July report showed Dynamics 365 revenue growth decelerating to 13%. The qualitative explanation for this deceleration also shifted.
The consumption transition framing utilized in April was completely absent. Instead, management named customer relationship management weakness directly.
They cited longer sales cycles and deal scrutiny, while noting enterprise resource planning remained stable.
The growth rate declined by nearly half, and the language evolved from describing a structural industry transition to acknowledging specific segment elongation.
Next, we examine the evaporated narrative label, starting with Copilot Studio. This is Microsoft's low-code tool for building customized AI agents.
In April, this product was granted significant real estate in the prepared remarks.
Management stated nearly 90% of the Fortune 500 had active agents built with their tools, and that Copilot credit consumption was up nearly 2x quarter over quarter.
It was explicitly positioned as the definitive traction metric for enterprise agent adoption.
In July, Copilot Studio was completely absent from the prepared remarks. The 90% Fortune 500 statistic was retained, but it was reassigned to different products.
It was attributed to Foundry, Fabric, and Work IQ grounding. No update was provided on the 2x consumption growth figure.
The named product and its associated traction metric were systematically removed from the narrative sequence.
A structural omission occurred with Security Copilot as well. The April call featured a primary headline metric where management stated the number of Security Copilot customers increased 2x year over year.
In July, the security narrative expanded to include Project Perception, a new agentic security system, and management cited 15 billion per-view interactions.
The broader security story grew materially in scope, but the specific Security Copilot customer count vanished. The specific denominator was substituted for a broader ecosystem metric.
We must also track narrative inertia regarding the MAI model family. Narrative inertia occurs when the positive framing of an initiative remains constant, but the specific, verifiable engineering proof points are quietly abandoned.
In April, Microsoft utilized highly specific launch proofs for their first-party model efficiency. They cited MAI Transcribe 1 delivering a 67% increase in GPU efficiency, and MAI Image 2 delivering up to a 260% increase.
In July, the references to the MAI models remained extensive across the call. Management listed MAI Code 1 Flash, Cyber 1 Flash, and several others.
However, the emphasis shifted entirely from verifiable launch efficiency to general deployment scale.
The specific 67% and 260% hardware efficiency claims were replaced by broader claims of 89% GPU cost reduction in Dynamics 365.
The positive narrative continued to move forward, but the granular engineering proofs faded into generalized portfolio statistics.
We observed this deceleration most acutely with the Cobalt CPU trajectory. In April, management positioned the custom Cobalt CPU as a primary infrastructure proof point.
They noted deployment in nearly half of their global data center regions, named specific enterprise customers utilizing the hardware like Databricks and Siemens,
And explicitly signaled they were expanding Cobalt supplies significantly to meet high demand.
In July, the Cobalt CPU received exactly 2 sentences in the prepared remarks.
A new, brief list of customers using Cobalt virtual machines was provided, and a target of 25-plus data centers by month-end for Cobalt 200 racks was noted.
While the information is incrementally positive, the strategic emphasis evaporated. Furthermore, Cobalt generated 0 inquiries from the analyst pool during the Q&A session.
A featured expansion signal in April was reduced to a passing line item in July.
Advancing our audit, we review architectural positioning and accounting nuance. This focuses on how the macro pitch to enterprise software customers fundamentally evolved.
In April, the platform proposition emphasized model choice, open weights, and access to over 10,000 different AI models.
The architectural argument was based on breadth and operational optionality.
The July positioning introduced a quasi-sovereignty argument. The focus shifted heavily to enterprise intellectual property protection.
Management repeatedly emphasized that the software harness, the context window, and the operational memory belong strictly to the customer, not to the underlying model provider.
The messaging pivoted mechanically from hosting all the models to ensuring your proprietary data is protected from the models. It is a fundamental alteration in the enterprise value proposition.
This shift must be contextualized by management's complete silence on the OpenAI agreement restructure during the July call.
In late April, Microsoft restructured their OpenAI terms, securing royalty-free IP access through 2032 and adjusting the underlying revenue share dynamics.
The April call addressed this directly, labeling it a win-win construct. The July call omitted it entirely.
The new emphasis on multi-model substitutability and enterprise data sovereignty serves as a structural counterweight to their heavy reliance on the OpenAI frontier models.
We must also audit the accounting precision regarding the $3.2 billion Anthropic mark-to-market gain reported in July. Let us define a mark-to-market gain for the listener before assessing the presentation.
A mark-to-market gain is a paper profit. It reflects the increased valuation of an asset held on the balance sheet. In this case, Microsoft's financial investment in the AI company Anthropic.
It does not represent cash generated from selling Microsoft products or services.
Amy Hood disclosed this cleanly in the detailed financials as a non-recurring gain that added $0.27 to undiluted earnings per share versus their prior guidance.
The disclosure in the filings was technically compliant. The analytical friction arises in the verbal presentation on the call.
The headline, earnings per share of $4.74, remained unadjusted for the Anthropic gain when read aloud.
In the opening remarks, this consolidated figure was grouped alongside statements regarding strong demand and execution.
A non-recurring mark-to-market investment gain was commingled with operational revenue performance in the initial framing.
By not breaking out that $1.27 paper profit when reading the headline EPS, management placed the burden of separation entirely on the reader of the transcript.
We now proceed to the Q&A response quality audit. This is a mechanical assessment of how management handled direct analyst inquiries under pressure.
We classify responses as direct, partially direct, or indirect, based strictly on whether the specific mechanism of the analyst's question was addressed. We begin with Brent Thill from Jefferies.
He asked whether the Azure revenue acceleration was due to a changed macroeconomic environment or better internal execution.
Hood's response to Thill was direct. She confirmed demand still exceeds supply, named fleet efficiency and rack installation as the exact execution drivers, and confirmed these imbalances are quickly monetized.
The response provided specific operational mechanisms aligned completely with the premise of the question.
Carl Kierstead from UBS asked a structural margin question regarding the financial mechanics of custom versus frontier models, given the new enterprise emphasis on model choice.
Nadella and Hood's response to Kierstead was partially direct. Nadella addressed the architectural philosophy, the separation of the software harness from the underlying models.
Hood redirected the margin differential inquiry by stating Azure infrastructure is fungible.
Let us define fungible here. It means the infrastructure can be easily repurposed from one task to another.
This classifies as partially direct because it answers the infrastructure allocation question, while entirely bypassing the core inquiry regarding the unit margin differential between serving a frontier model versus a self-hosted custom model.
Mark Mordler from Bernstein probed the CapEx guidance constraint. He asked a specific question regarding how management handles hardware component price increases without raising customer prices or compressing operating margins.
Hood's response was indirect. She emphasized portfolio diversification, flexibility in the timing of short-lived assets, and the general value proposition of cloud computing.
She did not provide the pricing pass-through mechanism requested.
Absolutely. A direct question regarding the margin impact of component inflation received a structural portfolio answer, avoiding the unit economics of the hardware altogether.
Finally, Gabriela Borges from Goldman Sachs asked a definitive quantitative question. Her exact phrasing was, "How does your math on ROI compare to a year ago?"
Hood's response warrants exact quotation. She stated, "I don't know that my math has changed."
She then proceeded to list the input variables: TAM expansion, margin levers, model diversification, and silicon efficiency.
TAM expansion refers to the total potential revenue opportunity growing larger. We classify this as indirect.
Hood provided the model's theoretical inputs rather than the calculated output.
When an analyst asks if the return on investment calculation has changed, and the response is a recitation of the variables without a comparison of the aggregate estimates over time, the fundamental premise of the inquiry has been sidestepped.
To conclude this audit, we must establish the new baselines introduced in July. These will serve as the measurement anchors we audit for continuity during the Q1 FY 2027 call.
Agent 365 was introduced with a baseline of 40 million registered agents. Project Perception was launched as a multimodal security system transitioning to a consumption-based offering.
The E7 Enterprise Suite was announced, highlighted by an EY deployment of 400,000 seats. Finally, Horizon GB was introduced as a managed PostgreSQL service.
These are the specific metrics we will track 90 days from now. Management utilized the July call to explicitly frame that Microsoft has crossed from the build phase into the compound phase.
You have heard the mechanical breakdown of the Q4 deliverables. You have tracked the convenience pivots in CapEx accounting, the baseline adjustments in infrastructure efficiency metrics, and the evaporated narratives in the security and low-code segments.
We leave you with this final analytical consideration. Are the shifting measurement windows and evaporated product metrics observed in this audit the natural expected byproduct of a company maturing into that compound phase? Or are they early mechanical indicators of structural ceiling limits in the enterprise AI market?
The judgment belongs to you.